The Great Depression of 1929 is a critical event in economic history that profoundly affected global economies. Various economic schools of thought, Keynesian, Monetarist, and Austrian, offer different explanations for the causes of this crisis. Each perspective highlights distinct factors and provides unique insights into the origins and solutions to the Great Depression. Keynesian approach. The Keynesian perspective, developed by John Maynard Keynes, emphasizes the role of aggregate demand in driving economic activity. Keynesians argue that the Great Depression was primarily caused by a severe and sustained drop in aggregate demand, leading to widespread unemployment and economic stagnation. Cause of the crisis. In the Keynesian view, the 1920s were marked by economic imbalances. Technological advancements and increased productivity led to overproduction, but income inequality prevented a corresponding rise in consumer demand. A significant portion of the population did not have the purchasing power to buy the goods being produced, leading to an accumulation of unsold goods. This situation was worsened by the speculative boom in the stock market, fueled by easy credit and overconfidence in the economy. When the stock market crashed in October 1929, it triggered a loss of wealth and a sharp decline in consumer and business confidence, causing a dramatic drop in spending and investment. Key factors. Keynesians highlight the role of sticky wages and prices in deepening the depression. In a deflationary environment, as seen during the 1930s, prices fell, but wages did not adjust as quickly. This mismatch led to reduced profits for businesses, forcing them to cut production and lay off workers, further reducing demand. The lack of timely and adequate government intervention allowed the economy to spiral downward as private sector demand continued to shrink. Solution. According to Keynesians, the solution to the Great Depression would have been proactive and aggressive government intervention to boost aggregate demand. Keynes advocated for increased government spending on public works, infrastructure, and social programs to create jobs and stimulate consumption. Tax cuts for lower and middle income groups would have also helped increase disposable income and spur demand. The New Deal, implemented by President Franklin D. Roosevelt, partially reflected Keynesian principles by increasing public spending and creating job programs, which helped to mitigate the worst effects of the Depression. Monetarist approach. The monetarist school, led by economists like Milton Friedman and Anna Schwartz, focuses on the role of the money supply and monetary policy as key determinants of economic performance. Monetarists argue that the Great Depression was largely caused by a catastrophic contraction in the money supply, exacerbated by the Federal Reserve's failures. Cause of the crisis. Monetarists contend that the Federal Reserve's policy mistakes were the primary cause of the Great Depression. In the late 1920s, the Fed raised interest rates to curb stock market speculation, leading to a slowdown in economic activity. However, after the stock market crash, the Fed failed to provide sufficient liquidity to the banking system. As banks began to fail, the money supply contracted sharply, leading to deflation, a decrease in the general price level. This deflation increased the real burden of debt, causing widespread bankruptcies and further reducing spending and investment. Key factors. The deflationary spiral is a central concern for monetarists. As the money supply shrank, prices and wages fell, leading to lower incomes and reduced consumer spending. This contraction in demand led to further economic decline, creating a vicious cycle. The Fed's inaction, particularly its failure to act as a lender of last resort, allowed bank failures to snowball, further contracting the money supply and deepening the depression. Solution. Monetarists argue that the Federal Reserve should have adopted a more expansionary monetary policy to counteract the economic downturn. By increasing the money supply, lowering interest rates, and providing liquidity to banks, the Fed could have prevented the deflationary spiral and mitigated the severity of the depression. Friedman and Schwartz suggest that if the Fed had acted more decisively, the depression might have been shorter and less severe. Austrian School of Economics approach. The Austrian school, associated with economists like Ludwig von Mises and Friedrich Hayek, offers a different perspective. The Austrian approach focuses on the role of credit expansion and the distortions caused by government and central bank interventions in the economy. Cause of the crisis. The Austrian school attributes the Great Depression to the unsustainable boom of the 1920s, which was driven by excessive credit expansion and artificially low interest rates set by the Federal Reserve. This easy credit led to widespread investments in unproductive or unsustainable projects. According to Austrians, the economic boom of the 1920s was a bubble waiting to burst. When the Fed eventually tightened monetary policy, it triggered a necessary correction. The stock market crash and subsequent economic downturn were seen as the economy's way of adjusting to the reality that many of these investments were not viable. Key factors. Austrians emphasize the dangers of government intervention and artificial credit expansion. They argue that the Depression was a necessary period of economic adjustment where bad investments were liquidated and resources were reallocated to more productive uses. Attempts to prevent this adjustment, such as government spending programs or monetary stimulus, are seen as counterproductive and likely to prolong the Depression. Solution. The Austrian school advocates for a hands-off approach, allowing the economy to correct itself naturally. They believe that the government should not interfere with the market process of liquidation and reallocation, as doing so only delays the recovery. In their view, the Depression was a painful but necessary process to restore economic equilibrium. Each of these three approaches offers a distinct perspective on the causes of the Great Depression. Keynesians focus on the collapse of aggregate demand and advocate for government intervention. Monetarists emphasize the role of monetary policy and the importance of a stable money supply. The Austrian school highlights the dangers of credit expansion and the need for economic corrections. Together, these perspectives provide a comprehensive understanding of one of the most significant economic crises in history.